2026, the year everyone suddenly became a car expert. Your Instagram feeds filled with car reels. Your WhatsApp status, someone just bought their dream car. And your family group chat, uncle forwarding you EMI calculators at 11 p.m. But here's what nobody's talking about. A simple rule that could save you from your biggest financial mistakes of your 20s and 30s. And it's called as a 20% rule. And I'm about to show you something that will completely change how you think about buying a car. I built this analyzer using Excel, and honestly, it scared me. Not because it's complicated, it's actually dead simple to use. It's scary because what it reveals. And there are two parts to it. First, we look at the real monthly cost of owning the car. And then there's a second layer. We'll come to that in a bit. But let's first start with affordability. Open this sheet. First cell, your annual income. Let's say it's around 12 lakhs, right? Pretty standard for a lot of young professionals today. Next, income tax. And in this case, it's zero. So your take home stays at 12 lakhs. Now, here's where it gets real. The on-road price. Not the showroom price, what you see in the ads, the actual price I'm talking about. And is that 12 lakhs? No. By the time you add road tax, registrations, insurance, and accessories, it suddenly jumps to 14 lakhs. And always, try to get the complete breakdown on road price from your dealer. Don't trust the advertisement price. Next, we have the down payment. Usually, it is expected to be around 20% of the on-road cost. And in this case, that's 2.8 lakhs. Loan tenure, 5 years. Interest rate, let's say it's 9.5%. And there it is. Your monthly EMI is 23,522. So every month you'll get a message, your payment of 23,522 has been deducted every single month for 5 years. But wait, that's not even the real number. Most people stop here. They think 23,522 is what a car costs per month. But that's a trap. Let me show you how you should be calculating it. Running cost, you're driving 600 kilometers a month. Fuel efficiency, 15 kilometers per liter. Petrol, 105 rupees per liter. That's 4,200 rupees per month. And activate your EMI, and suddenly it becomes 27,722. And we are not done yet. Insurance, 28,000 annually. Even a small scratch or a bumper damage can run into thousands. And that's why most people end up taking a zero depreciation coverage, not just the basic, third party coverage. And next is maintenance, another 22,000 per year. Regular servicing like the oil changes, wheel balancing and alignment, and those small rattles and fixes that start showing up sooner than you expect. So that's 50,000 yearly or 4,167 rupees per month. So your new total becomes 31,889 per month. And still, it's not done yet. Parking, 1,000 rupees a month. Tolls for those weekend drives, another 667 rupees monthly. And because you will take that trip to the hills, you will also drive to that amazing restaurant 2 hours away. Another 1,667 rupees monthly. So your real cost actually comes out to be 33,556, not 23,522. 33,556. Here's the summary that will make you pause. That 14 lakh car you bought over 5 years of ownership, it actually cost you 20 lakh 13,360 rupees. Your monthly income, 1 lakh rupee. And here's the killer. That's 34% of your net income in year 1. The 20% rule says that the car should not be more than 20% of your take-home income. You're close to 40%. Now, but you tell me, right? Dheeraj, my salary will go up every year too. And I trust that happens, right? Let's account for that. 10% annual increment, and that's being generous. But since you're considering salary increase, we should also factor in inflation. So let's say it's 6%. Now, watch what happens over the next 5 years. Year 1, 34% of the income. Year 2, 31% of the income. Year 3, 28% of the income. Year 4, 26% of the income. And year 5, 24% of the income. It drops, yes, but you are still spending nearly a third of your income on a depreciating asset for 5 years. So, what's the fix? There are basically 2 levers you can pull. One is change the car price. That 14 lakh car becomes 10 lakh, everything shifts. 2, increase your down payment. from 20% to say 40%, and suddenly your EMI drops dramatically and that monthly burden becomes manageable. So keep adjusting the down payment until the percentage drops to 20% or below. Remember, the higher the down payment, the lighter you breathe every month. So that's was what the first layer is. Now let's go to the second layer as I mentioned earlier. And for this part, there's no need for Excel or calculations. You just need a page, a pen, and 5 to 10 minutes of your brutal honesty. Split the page into two halves, okay? And once you do that, on the right hand side, write down all the stuff you want to own. The latest iPhones, PS5, a super expensive watch, whatever makes that list, right? And on the left side, what I want you to do is that write down all 3-4 experiences that would help you create amazing memories. Not crazy expensive, but not cheap either. So with a little smart planning, you should be able to pay for them. So it could be like maybe scuba diving in Maldives, or a motorcycle trip through Ladakh, or a month-long solo backpacking trip, right? Whatever makes you happy, just put that on the list. Now, just be honest and rate them on both sides. On a scale of 1 to 5, whatever brings you more joy. Just do that right away. And I've asked this question to many people I know. And guess what? The experience rated always higher. Consistent 4s and 5s. The products, mostly 3s. And that's the difference that matters more than it looks like. If you are in 25 to 35 right now, you are in your highest energy decade. You can trek, you can travel, you can learn new skills, you can take risks. An EMI of 33,000 per month doesn't just take money, it takes away options. That trip to Japan? Can't. EMI is due. That course you wanted to do? Can't, because EMI is due. That business idea? Too risky. EMI is due. Understand this. You are not choosing between a car and a no car. You are choosing where to lock in a large monthly commitment. And because some purchases have little to no value over time, and some experiences are easier to have at a certain age and energy level, just think about it. The real question isn't about whether you can afford the car. It's whether this is the right moment to trade flexibility for it. And that's what the second layer is all about. Pause. Look past the EMI. Look past the excitement. Because the smartest money decisions aren't what you can buy. They're all about what you don't have to give up. So if you actually did this exercise in your head, I'm curious, which side is scored higher for you? The stuff or the experiences? Let me know in the comment section. And if you found this useful, please do hit like. And if you want more such honest breakdowns like this, subscribe to the channel. See you in the next video.